why we exited the stocks before the budget. Because budget day was one of the most volatile days, and has been observed in the past also that it has been the most volatile. The market is volatile on those days basically. Our portfolio would be balanced equity portfolio, we all agreed on it, consisting of various sectors. Basically a diversified equity portfolio. We would buy a mix of growth and blend stocks. We would seek profit by buying undervalued stocks, but at the same time, they should be fundamentally strong. We would try our best to outperform the benchmark which we have taken. We would obviously like to time the market, and the timing of the market is very important for us. The team philosophy, basically the objective was, since the time span was so less, just 60 days of trading days available to us, we wanted to generate short-term capital appreciation by investing in portfolio comprising of fundamentally strong stocks from Nifty, benchmarking Nifty itself. Investment process is the result of our belief in the applicability of business cycles, as well as combination of top-down macroeconomic analysis and bottom-up securities research. When I say top-down macroeconomics, I mean to say that we would be looking at sectors first. We divided all the business into sectors, and we know there are a lot of indices available which are good indicator of how the sector is performing. So we selected the sectors, and then we did the equity research for individual stocks which are available in the market based on some screening criteria, which I will show you in the later slides. And as you can see, the investment style, which consists of basically growth, blend, and value, and small, mid cap, and large caps. Our investment style lied in the red region, which is clearly visible, from mid cap to large cap and from growth to blend. Our investment plan was basically a growth plan. The fund was launched on 2nd January 2015. Benchmark being Nifty, fund size 1.25 lakhs. The risk profile was moderate, and this was a result of risk profile of everyone. Here, everybody had a different risk profile, and we came out with the conclusion that we will have moderate risk, and we will try to minimize volatility as much as possible. Actually, everybody was on the downside of the moderate. So low to moderate, and the rest, one of them was only high. So I will go through the risk profile later in the slides and come to know what actually happened. The minimum investment, we decided that 85% of the fund will be allocated to the equity, and fund manager is Vineet Jain. The risk profile, how was it done? There are a lot of tests available for deciding what kind of risk profile you have. So we took one website which gives us a correct indication of what kind of risk every individual in the team can take, and we found that most of them lied in the medium region, except for Sunil, who has worked in options and futures course, and was the toppers of the options and futures course, and he was having high risk. And our fund allocation was basically 84% to equity, 14% to mutual fund, and 2% as cash. When we took the decision of investing in mutual fund, was basically to hedge our position, and as I shown you in the previous slide, the growth, blend, and value, the investment style of this fund which we chose, that is ICICI Prudential Value Discovery Fund, had the opposite style of what we had. So it was basically hedging, but only to a certain extent. So our risk management was basically an upside review of the portfolio at 5%. When it reached 5%, we would analyze the future prospects of each stock and review the weights allocated, continue holding the stock or book partial profit, and we booked partial profits in few of the stocks like HCL and Lupin. I'll take you through what were the stocks and how it happened. Downside review was at -5%, booking partial loss and exiting the bad performing stocks. While we'll select new stocks, analyzing future prospects, and then again allocating the weights. The initial fund allocation was in these 4 sectors: pharma, auto, bank, and IT. And I would take you why we choose these sectors as the best bets for us, but in the later slides. So for 40% being the highest for IT in the beginning, pharma 30%, auto, banking 10 and 20% each. So we explored our investment process. After discussing a lot, we come up, as I said, we'll first selected the sectors, the macroeconomic analysis, pick the sectors by analyzing the macroeconomic analysis, and then use the quantitative filters, which were basically on 3 multi-factor model: growth, value, and hybrid. Like you have for growth, we saw that the quarterly results were due for the 3rd quarter, that is the month ending December. So we saw the quarterly results of lot many companies which were which were in our portfolio or which were under the sector, and we found that whenever a good quarterly results has come out, the stock has gone up, or the investment sentiments show that they are interested in buying that stock. Earnings revision, return on equity, the long-term 5-year consensus growth rate of their sales and profit, value as in P by E ratio and price to book, and hybrid as price to earnings growth ratio. Qualitative filters were basically more on the side of how the management is during the conference calls, when the management says that they are going to do this. Let's say in 2009 or 2010 they said that we are looking for a vision, in 2013 we want to reach these sales, and whether they are actually doing stuff what they have said or not. And they don't stick to what they have said, that means the management is not that great. Or maybe the management is trying to say something which is not being done, and trying to create an investment sentiment for some time. So basically we also saw the qualitative management team, the short-term and long-term plans of the company, and core competencies of the company. Warren Buffett once said that you should pick the stocks which have at least a very strong competitive advantage, which can actually, you can gain from the company's performance. Like he bought Gillette, he bought a lot of companies which were on the same parameters. We saw that what core competencies this company has, or is it having some kind of sustainable competitive advantage which can be have strong future prospects. We didn't buy with the perspective of only 2 months. I mean, to be frankly, we didn't buy the stocks with the perspective of only 2 months and trying to end somehow with a good profit and trying to create huge profits. We did fundamental analysis, and then we decided whether to buy or sell the stock depending on these filters and depending on these criteria. Moving ahead, the sector selection criteria. What we did was we took all the indices of sector indices of different sectors: pharma, FMCG, auto, bank, IT, and so on and so forth. And we found that there are 5 sectors which have the maximum Sharpe ratio, and looking that, we decided these sectors are the best sectors to go for. FMCG being a defensive sector, the beta of stocks which are in the FMCG sector is comparatively lesser, as they don't move as per the stock market. So we took these 4 sectors and one FMCG sector as a backup sector. Sector overview, pharmaceutical sector, we actually picked, 2 of us in our team had actually strong background in working with the pharmaceutical sector during the internship. They have done very strong equity research for Dr. Reddy's and Lupin during their tenure at their respective companies. So the analysis done by our team was that we found that it's one of the leading pharma, India is one of the leading pharma producers, and it actually consists of 10% of sales of the global sales, and third largest in the world in terms of value, 1.4%. The industry is going very fast at a CAGR of 17.8%. It is expected to reach about 36 billion by the end of 2016. There is a patent cliff which actually, after every 20 years, the patent gets expired, and it is an opportunity for generics to enter the market. The generics get an opportunity to utilize the research done by the people who are innovators, actually, who created the drug first. So they can utilize the patent after 20 years expiry, and then this is an opportunity for Indian players to enter the market. And there is a huge emerging economy. The growth prospects are very strong for pharma sector, and nearly 40% of the cost is lesser as compared to the US markets. The growth drivers being under filings, patent cliff, aging population, higher affordability, and changing lifestyles. The IT sector is one of the booming sectors. Again, we took the IT sector base because it is a leading outsourcing destination. India, as most of the crowd sitting here would be IT engineers, and we would definitely, it's one of the strongest sectors in India. Global delivery capabilities. India has strong growth opportunities with a CAGR of 25% over 2013. By 2020, the industry is expected to reach $300 billion US. Competitive advantage, we have a huge talent pool. Cost competency is 3 times, 4 times lesser than the US. Segments market size, IT services have about 56.3 billion, BPM 20.9, and software 17.9, hardware 13.3. Growth drivers are basically social media, analytics, and cloud computing, that is SMIC. SMB market, IT adoption in major industries, technology element in emerging verticals. The automobile sector is another one of the interesting, the 5 sectors which we picked, automobiles was another one of them. India is the 7th largest automobile producer in the world, with annual production of about 17.5 million vehicles. It is 8 of the companies which we picked, we found that most of them had 10% annual sales growth in annual sales, and the country is a growing market. Positive growth at 12.9% year on year to reach a sales of 13.5 million units by October 2014. Moving ahead, we have banking sector. We have seen a lot of movement in these 2 months with the RBI cutting repo rates twice, 25 basis points each. The credit growth in this sector is improving, and it has reached 15 to 70% in 2014-15. Growth in car expected to reach actually. Growth in car and utility vehicle loans has seen a growth of 18-20%. Infrastructure investment is obviously going to rise with Modi government going for huge investment in infrastructure. Growing market, growth in housing finance disbursements to grow at 16% CAGR. Issue of licenses to new banks like IDFC and Bandhan Finance is another good sign for this sector. Growth drivers are basically retail banking, credit growth, working capital business, and financial inclusion. Yeah, last sector would be the FMCG sector. FMCG sector is expected to increase at a CAGR of 14.7%. The rural FMCG market anticipated to increase at a CAGR of 17.7% to $100 billion during 2012-25. The market size is expected to reach about $135 billion, but from $44.9 in 2013. Has grown at an annual range average of about 11% over the last decade. Growth drivers being economic growth, rising rural income, urbanization, evolving our lifestyles. The stock selection criteria for our group was basically on these 3 filters. We took basic filters, the fundamental filters, and the qualitative filters, as I said. We took the institute has actually designed basic filters for us, which says that BSE 500 stocks or NSE 500 stocks with a minimum market capitalization of ₹300 crores. Undervalued by fundamental and relative valuation methodologies, consistent with the risk profile of the team, which is clearly visible in our portfolio. So when we use all these filters, the fundamental filters being positive free cash flows, net income over 3 years increased should be positive and increased every year on year. Minimum return on equity should be greater than or equal to 15%. Return on minimum growth of yearly revenue over 3 years is greater than 20%. So what we did, we used first higher filters. When we increased the percentage of sales, we found that the number of stocks had come down, and it was difficult for us to pick only one stock out of all the stocks, or maybe there was no stock at all which was actually having all these parameters fulfilled. So we reduced it to 12%. The qualitative filters being strong corporate governance, which was analyzed with the team, ethical and transparent process, strong management team, and philosophy. So these 5 sectors gave us stocks as Lupin, Dr. Reddy, Tata Motors, and Maruti Suzuki. In auto sector, IT they had HCL and TCS. Banking, IndusInd Bank and Yes Bank. FMCG as ITC. The fund overall performance, when we started the investment, it was given as 1,25,000. The weekly performance, we actually came down by about 3% in the first week. Second week, we were again down 1.7%. Third week, we came down 0.5%. Overall, 0.5%. I mean, the portfolio value was 0.5% down from 1,25,000. When I'm saying the percentages, basically, from the value of 1,25,000, we reduced by about 0.5% in the third week. Fourth week, 2.8%. Fifth week, 1.1% up. 4.5% up in the sixth week. Seventh week, 5.6% up, and we closed at 4.67% overall. So, in the beginning, we were thinking that actually the Nifty is following us. And we were surprised what is happening. And in every investment process was basically on the, the decisions which we made in the beginning, the philosophy of the team and the investment process of the team. The active return came out to be minus 0.2%. The portfolio beta with respect to benchmark was 0.7. Portfolio beta with respect to market was 0.752. Benchmark beta was 1.052. Residual return minus 0.016. Residual risk 0.568. Information was positive, and which was good sign for us, being 0.016 in case of KPM model, and 4-factor model was 0.02. The Sharpe ratio came out to about 0.089. Trainer ratio 0.109. Mean daily log return was 0.212%. Jensen's alpha 0.009. And Sortino ratio 0.186 and upside potential was 0.226. This was the overall fund performance. We exited the portfolio on 27th February, just before the budget day. We exited the stocks at different levels. The week one holding stocks were HCL, Lupin, Tata Motors, IndusInd Bank, TCS, and we had different returns from these stocks. We had the same stocks continued. The best thing which I found in my team was we did the least number of transactions. We tried to stick to our belief and stick to our portfolio by reducing our volatility and reducing our risk. Since we all were lying in the moderate risk and we wanted to reduce our risk, we exited at a time when we felt that it was right for us. We had designed our exit strategy to the point, which I will discuss in the next slide. First, let me take you through the stock-wise fund performance. Dr. Reddy was we holded the stock for 28 days and we exited the stock on 24th February with a profit about 4.04%. HCL Technologies gave us a profit about 10.5%. The number of holding days was 13 days. We thought when we first entered HCL, we entered HCL twice. Because when we first bought the stock was bought at a value about 1500 levels, and then it went up. We sold when it reached about 10.5%. We said it's the right time to exit because in 7 days, 13 days, what can you expect? 10% return was the best. Yeah. And HCL Technologies exited stock at -6% second time. IndusInd Bank 4.77, and these are the respective values which we found out. The mutual fund gave us a return of about 6.49%. The exit strategy, Lupin, when we exited, the Lupin already given us a return of about 14%, and we felt the stock was very good because they had so many new things coming up. They were entering new markets, new segments, and there were concerns raised over its Pithampur plant, which is the largest producer of drugs for Pithampur plant. Pithampur is a major producer plant. HCL Technologies, there was a problem with euro, and there was an issue coming with Greece, when Greece was going to exit from the European Union, but it didn't happen. But we exited because we were worried that it will affect our profits. TCS, company had actually laid off over 3,000 employees, and the stock tumbled like anything. Tata Motors, the results was sales of JLR had come out, and the number of units sold were less than compared to what the market expected. ITC gave a negative implication due to increase in excise duty. We expected that the excise duty will be brought up, so we exited the stock. Dr. Reddy was under the US scanner on generic drug pricing of two of its drug in Russia. Maruti Suzuki, to avoid the impact of huge volatility in the market, basically these three stocks, Maruti Suzuki, IndusInd and Yes Bank, were exited just before the budget day, thinking that we would be impacted by the budget day and we wanted to reduce volatility as our investment philosophy. So we didn't want to take that risk and we opted out of the market. But if we would have stuck to it, then maybe we would have got even better returns. Yeah. And overall fund performance ended with 4.67%. That's the end of. Last line I would say that like everyone says that the market is subject to risk. So I would end my presentation by saying that the lines which every mutual fund says, that mutual fund subject to market risk. Please read the offer documents carefully before investing. Thank you.
My question,
yes, sir.
See, what was the Nifty return in the same period?
Nifty return was higher than us, about 6%.
Okay. So you actually underperformed Nifty?
Yes.
Because this is without considering the cost. So if you had added 200...
No, this is including the cost, including the transaction cost.
No, but your cost. Somebody has to pay your salary, no?
Right.
Right, so because you are a fund manager.
Yeah.
So if you are adding 2% cost, effectively your performance is 2.67%.
Correct.
So you've actually produced 3.5% negative alpha. Correct? Yes. On Nifty.
Yes.
Right. Because when you look at IPRO is at 6.5%. That is after 2.5% cost. So technically when you compare like to like, 6.5 is actually 9%, right? 6.5 plus 2.5. So you have, your performance is, if you want to compare it on a gross basis, you have produced 4.67 against 9% of your IPRO. That is one observation. Second is your weightages. When you are saying that we want to have a lower volatility, your weightage in pharma, when your objective started with an objective to beat Nifty, right?
Yeah.
Your objective was to beat Nifty.
Outperform.
So did you ever consider the Nifty composition of industries? Because your selection of industries has completely no connection with the Nifty underlying industry weightages.
Sir, when we gave the weightages to all the stocks, it was basically on minimum variance criteria, and all the stocks were there in the Nifty, but the weightages given by Nifty were different. And we based on our philosophy, we followed the path. If we had holded the stocks, we holded the stocks which we had taken in the beginning and not exited them at all, we would have given a return of about 11%? 9%. If we would have not exited any stock which we exited because we wanted to, 27th we exited. And if we would have held on till the budget day and the next date also, it would have actually given us more returns. I can show you what our...
No, we are discussing the returns of as of the day, and the comparative returns that you have given is as of that day only, no?
No. Yes, that.
So let's not discuss that what happened and what not happened. We are only comparing your performance vis-a-vis the objective that you set in. That objective that you set in was to beat Nifty, and which doesn't seem to have happened. After you consider the cost, in fact, the gap is very high.
Correct.
My only observation here is when you are saying that I want to beat Nifty, you have to respect the composition of Nifty. You have completely ignored the underlying composition of Nifty, and probably that is the reason why you have seen such a large variance in your performance versus Nifty.
Yeah. What was the logic of allocating money? So just to supplement Kirkire sir, the composition of Nifty, one thing where I differ is 2% need not be deducted because it's a 2-month performance. So it needs to be 2 by 12 into 2. Okay. So yeah, but it is underperformance. Yeah. So it would be about 50 or 40-50 bips that needs to be deducted. Anyway. So what was the reasoning for allocating money to value discovery fund?
Sir, our investment style we showed in the beginning, right?
No, you don't need to show, just
Yeah.
take.
So our investment style was basically consisting of growth and blend stocks.
So you were trying to complement your
Yeah.
style with the value
Yeah,
discovery.
just trying to hedge our position.
Not hedge, complement.
Complement.
Okay. What's the benchmark of value discovery fund?
CNX mid cap.
And what is your benchmark?
My benchmark for equity total portfolio is Nifty.
So how do you allocate money to complement your style to a fund which has a different benchmark?
Our just 15% of our money were invested in that mutual fund. So
Point is, what was your objective of investing into value discovery? To complement your style
Complement,
or
yes.
to generate alpha?
not
You
to
said-
generate alpha,
Okay.
just
So when it was not to generate alpha, then just to complement your style, you have invested into a fund which is totally different mandate and different benchmark, right?
yes.
So how do you justify that?
The reason being, if the stocks in the mutual funds is not the large cap and the mid cap, it's a micro cap in the mutual fund. So we
That
invested
is the
in
reason I am asking. So your choice would have been justified if your objective would have been to generate alpha, but your objective was to complement your style. So then it should have been in a similarly large cap fund with a similar benchmark rather than a fund which is totally in a different landscape.
Sir, the stocks in the investment style, if you look at the small cap, mid cap, and large cap, I'll just show you the graph first once.
Understand his
No,
question.
just to add to him,
Yes, sir.
if I am your investor,
Yeah.
you are telling me my benchmark is Nifty,
Yes, sir.
but you are investing in a small cap. What are you telling me as an investor?
Sir, our investment style was basically like this, which is clearly shown in the picture. And if you have to take the opposite position, it has to consist of mid cap and small cap stocks. Just opposite investment style.
Yeah.
Yes. Just opposite style of this style, we had taken the